Now that we've discussed the importance of segment margin, we're going to use it to calculate break-even points for the company. So here's a segment margin for the business that we were looking at before. We have total company-wide income of $75,000, which is made up of the TV and computers division margins or segment margins, and then we reduce those segment margins, the $100,000 total, by the common fixed cost to get the operating income. So we can calculate a company-wide break-even point. How do we do that? Well, we have to remember our formula, which is the fixed cost of the company divided by the CM ratio. So the fixed cost, if I go back, is the traceable fixed cost and the common fixed cost combined. And then we get our CM ratio by taking our total CM for the company, which is the 270 divided by the total sales. So you have to remember back to chapter 5 some of the formulas that we learned there. So when we take our total fixed costs and divide it by the CM ratio, we determine that for the company overall to break even, they need to have sales of 361,111. We can also calculate the break-even point for each segment. So to do that, we're going to focus on the fixed cost and the CM ratios of each individual segment. So for television, our fixed costs that were traceable were 90, and for computer, it was 80. And then we get our contribution margin ratio by taking the CM of each segment divided by the sales. So you could see 150 and 300 for TV, and then 120 and 200 for computer. So that's where these numbers are coming from. And then that tells us the amount that we need to sell in each division in order for that division to break even. We're not including common fixed costs in this analysis. So if we were to sell these amounts in each division, the company would still lose money because each division would break even, but then we'd still have to take out the fixed costs that are common, which means the company overall would lose money. So it's important to remember that even if each division achieves its break-even point, the company overall may lose money because the common fixed cost wouldn't be covered at that point. And that's why the total sales that you see here, 180 and the 133, are less than the 361 that's needed to break even for the company overall. So the 180 and the 133 is 313. And that's different than the 361 needed to break even for the company overall. And again, that's because of the common fixed cost. So the 25,000 of company-wide common fixed costs are excluded when we do segment break-even because common fixed costs are not traceable to the segments. Therefore, they're not influenced by segment-level decisions. However, with that said, if each segment achieves break-even on their own, that's still not going to cover the common fixed costs, so the company overall will result in losing money. So common costs shouldn't be arbitrarily allocated to segments based on some rationale that someone has to cover the costs. And the reason for this is it would make profitable business segments appear to be unprofitable, and allocating common fixed costs forces managers to be held accountable for costs they can't control. Why should I be held accountable for things I have no control over? All that's going to do is make me as a manager of a division very jaded and angry and feel that I'm not being treated fairly. To kind of demonstrate that, we'll go through a little example with some quick check action. So we got Hoagland's Lakeshore restaurant, and you can see that the business is broken up into its two main components, the bar and the restaurant itself. And you can see they have a significant amount of common fixed costs, $200,000. So we have that information. The first question is how much of the common fixed cost of $200,000 can be avoided by eliminating the bar? So take a little pause and see if you can figure that one out. And hopefully you said none, because common fixed costs can't be eliminated by dropping one of the segments. That's why they're common fixed costs. If we can eliminate them, they'd be traceable. Now suppose the square feet is used as a basis to allocate common fixed costs. How much would be allocated to the bar if it occupies 1,000 square feet and the restaurant occupies 9,000? So this is just a little math here to do, so you can give that a try. And then basically to do the allocation, all you would do is allocate 1/10 of the cost to the bar. How do we get 1/10? Because the bar is 1,000 square feet. The restaurant is 9 for a total of 10,000. So the bar makes up 1,000 out of 10,000, or 10%. And the restaurant makes 9,000 out of 10,000, or 90%. And then you take the 10% times the 200,000, and that'll give you the 20,000 that gets allocated to the bar. It didn't ask, but we could also multiply, let me fix my writing here, 200,000. We could also multiply the 90% times 200,000 and determine that 180,000 would go to the restaurant. So what happens if we allocate costs to the segment? So if we allocate the cost, there's that 20,000 and the 180 we just talked about. It looks like the bar's not profitable, right? So the bar's losing $6,000. If we allocate those common costs, it looks like the bar's not a profitable part of the business, which may make management think that maybe we should eliminate the bar altogether and save money. So should the bar be eliminated? So what do you think? Hopefully you didn't fall into the trap. The answer is no. We shouldn't eliminate the bar because those common costs won't change whether we eliminate the bar or not. So you could see if we just have the restaurant numbers here, and then the common cost would go 100% to the restaurant because there's nowhere else to allocate it. The overall income is $30,000. Well, before, when we had both, let me go back to prove it, the overall income was $44,000. Well, what's the difference? Remember that segment margin's important. This bar is contributing $14,000 to the bottom line. So it may appear that the bar's losing $6,000 because you're allocating common costs to it, but really the bar's bringing in an extra 14. So if you eliminate the bar, your income is going to go down by that 14,000 because the common costs got to go somewhere, and they're going to get all pushed on to the restaurant. So what is the moral of the story? The moral of the story is we don't want to allocate common costs because doing so is going to result in us making inappropriate decisions. It's going to make profitable segments potentially look unprofitable, which may result in managers deciding to get rid of it, which in fact could hurt the company overall, as demonstrated by this example. A couple of wrapping up comments. I already mentioned this earlier, but GAAP and IFRS both require absorption costing for external reporting. So we need to use that absorption costing to do our external reporting and financial statements, but you could see to do a lot of our internal decision making, that variable costing and using the contribution margin or segment margin income statement format is far superior. So what that means is that companies are going to have to consider doing two types of costing methods, one for external reporting and one for internal decision making. What are the main differences between absorption and variable? As a reminder, fixed overhead costs are assigned to the product under absorption. So I keep thinking of a sponge absorbing extra costs. Absorption costing sucks up those fixed overhead costs. Variable costing, the fixed overhead costs are expensed in the period in which they're produced. The idea behind that is that no matter how many units we produce, the fixed overhead costs are going to stay the same, so we might as well expense them each period. rather than include them in product costs, because no matter how many units we produce, the fixed costs aren't going to change. And that's it for Chapter 6. As with all of our chapters, the most important thing you can do is practice. There's an abundance of practice on Canvas that is available to you, as well as some videos going through various problems. And then obviously on Connect, you have additional resources and practice problems and videos there as well. Please use the discussion boards if you have any questions. Don't forget to reach out. We want you to succeed.